pretend to be neutral here in terms of analyzing policy, but Trump's policies, and let's talk about taxes and lower corporate taxes, supposedly promise a 3 to 4% GDP economy as opposed to a 1.5 to 2% Obama economy. But I question that.
Bill Gross saying Donald Trump is going to damage the U.S. economy, basically drive the economy into the ditch. This as the Dow nears 19,000, the dollar hitting a nearly 14-year high. So is Bill Gross right, or is another titan, Ray Dalio, right? Ray Dalio is saying that Donald Trump won't recklessly and stupidly drive the U.S. economy into a ditch. Joining me now, we've got Bull Tiger Wealth Management partner Michael Lee, and basically you're a bear. Is that right, Jonas? MaxFunds.com co-founder Jonas Max Ferris. Jonas, looks like the Bulls are on the march and the Bears are on the run, but you're a bear.
I tend to side with Bill Gross, although to be like no one hates the last post-election markets more than Bill Gross because he's running a bond. Bonds have done very, very badly, and stocks have done very well, broadly speaking, and foreign bonds and stocks have done
lately really badly. Bonds,
and
right?
So like if you're running a global unconstrained bond fund like Bill Gross, this is not a good time right now, and it could get worse if it continues. However, I would agree with Bill Gross, except not tomorrow. I think it's going to happen years down the road when we have to pay for all this stuff. That could be a long time. In the very short run, like in the next few weeks, I do think we've already gotten most of the Trump bump, so to say, and without actual policies next year, it's going to be hard to continue that. In fact, I think some of the positives, so to say, of the dollar going up and rates going up will actually hurt the stock market ultimately if that continues. Yeah,
the Fed 90% chance of rate hike, you know, coming in December possibly. There could be some real whipsaw action. You know, Michael, you and I have talked about this, and so has Jonas. I mean, the economy, and I don't think the investor realizes how much of in a bubble land we've been since the 90s. Housing, and then the internet, and then the dot-com. And look, somebody said it's as if the economy of the past 20 years was wearing platform shoes. What do you think?
I think the U.S. consumer is in pretty good shape right now. What's missing and what has been missing from the Obama economy is fiscal stimulus, which we're going to get in Trump. So Republican House, Republican Congress, $100 billion a year at a simple 1.5, 2 multiple adds a point to GDP. You start bringing that offshore cash onshore, right? $2 trillion, you get 5% of that spent a year. Tonight with a 1.5, 2 multiplier, you get another point to GDP. Plus you add in a corporate tax reform, individual income tax reform. We could be seeing 2 years from now a 5 or 6% GDP. I do agree with Jonas that like we are in doomsday for the bond market. I think we've seen the top of the 30-year bull in the bond market.
Yeah.
But the economy is pretty good right now. It's not great, it's pretty good. And I think there's so many low-hanging fruit that Trump is going to get credit for because Obama couldn't get him through. So we're off to the races.
You know, Jonas, in the 90s we saw 6% average, 10-year rates, and then 4% last decade, thereabouts. Now, I mean, are people ready for inflation? Are they? I mean, I get it that inflation is upon us in food and health care, but we're talking interest rates going up, right?
Well, if people are truly optimistic about investing, they don't care if rates go. You can have a 5%. Back they were given 6% bonds in the late 90s, and people were still preferring stocks, right? So it's not like 3% rates are going to destroy the stock market unless there's no underlying expectation of strong earnings growth. Now, if you have the dollar keep going up here, it's going to be hard to create that. We are definitely transitioning from monetary stimulus to fiscal stimulus. I would think Bill Gross would like that. He's kind of been leaning towards that for years.
Yeah.
He just doesn't like the tax cuts part of it. He likes the borrowing and spending part of it.
That leads to inflation, too. Well, you know, right? So, you know, forecasts warm with the chance of stimulus. I mean, that's what we're looking at. But we also have a new Gallup poll. It says more than half of those who responded said, you know what, they're liking the economy under Donald Trump. What do you think, Michael?
I think interest rates are so low right now that all the savers out there are getting nothing. So the first couple rate raises, say the first 3 or 4, are actually going to be stimulative because people are going to start seeing some interest in their money market, some little bit more interest on their bonds and all the other income-providing tools, and people are going to have a little bit more confidence to spend a little bit more. So it's just when rates get so low, I don't think you help anybody. I think it's too far. So as we return to normalization, that should be stimulative for the economy. I think volatility is here to stay. But ultimately, stocks go much higher.
Right, Jonas? Final word. I mean, market volatility. We haven't really lived with normal market volatility. as the market usually behaves, right?
Well, it's been volatile, but it's been going up for so many years now, and it's mostly been on the expectation's been on an interest rate game, and now it's going to be real. It's going to be people have more money to spend with tax cuts. I don't think we're going to get. Look, when the Reagan era started and when Bush II era started, we had more room for tax cuts and spending because of where the deficit was. We can't go into it. It won't be as big as people think, I think, so maybe it won't be a complete disaster 4 years from now.
Thank you, Mike Lee, Jonas, Max Ferris. Good to have you guys.